It's 6:47 a.m. on a Monday morning, and a mortgage broker in Phoenix is staring at her screen. The rate she quoted a client on Friday? It's already obsolete. Somewhere in Washington, a confirmation hearing is about to upend everything she thought she knew about where interest rates are headed, and she's not alone. I'm your host, and this is Money Moves Daily. Today, the Fed chair fight that's quietly reshaping your portfolio. Here's what nobody's talking about. Kevin Warsh, Trump's pick to lead the Federal Reserve, just promised he won't be anyone's sock puppet, his exact words. But here's the twist. A Republican senator, one of his own party, is blocking the nomination. And the reason has nothing to do with monetary policy. It has everything to do with a DOJ investigation into the current Fed chair. Political theater? Maybe. But for your mortgage, your bonds, your retirement, this matters. Stay with me, because by the end of this, you'll know exactly what this standoff means for your money and what you might want to do about it. Let's rewind. Jerome Powell's term as Fed chair expires in May 2026. That's next month. And the search for his replacement has been anything but smooth. Kevin Warsh isn't a random pick. He served on the Fed's Board of Governors during the 2008 financial crisis. He's been inside the building when things fell apart. But Warsh brings something else, a reputation for being more hawkish than Powell, more willing to keep rates higher longer to crush inflation. That's a significant philosophical shift. And right now, the Fed is caught in an impossible position. Inflation remains above the 2% target, but the labor market is cooling. Growth is slowing. Then there's the wild card, geopolitical turmoil. The Iran conflict has driven energy prices through the roof, and that's pushing inflation higher when the Fed desperately wants it lower. Here's the current state of play. The Fed held rates steady at 3.5 to 3.5% at its March meeting. That's the third consecutive hold. And futures markets are telling us something important. They're pricing in no more than one rate cut for all of 2026. One. That's it. Consumer prices rose 0.9% in March alone. Producer prices up 0.5%. Much of that, soaring energy costs from the ongoing conflict. This is the environment Warsh would inherit. High inflation, slowing growth, geopolitical chaos, and a central bank that's been walking a tightrope for 2 years straight. On April 21st, Warsh sat before the Senate Banking Committee. According to CNN, he made one thing crystal clear. Quote, "I will be an independent actor if confirmed." He went further. When asked about pressure from the White House, Warsh said he wouldn't be Trump's sock puppet on interest rates. Those were his words, not mine. And here's where it gets interesting. Warsh called for, and I'm quoting CNN here, a regime change in the conduct of policy and a different new inflation framework. Regime change, new framework, those aren't casual words. Warsh is signaling he thinks the Fed got inflation wrong, and he wants to make sure it doesn't happen again. As he told the committee, quote, "Once you let inflation take hold in the economy, it's more expensive and harder to bring it down." That's a warning shot. So here's a guy who served during 2008, who thinks the Fed moved too slowly on inflation, and who wants to rewrite the playbook. That has real implications for rates. But here's the problem. Republican Senator Thom Tillis from North Carolina is blocking the nomination in committee. Republicans hold only a 12-10 advantage there. And Tillis's demand has nothing to do with Warsh himself. CNN reports he told the committee, quote, "Let's get rid of this investigation so I can support your confirmation." The investigation he's talking about? A Department of Justice probe into current Fed Chair Jerome Powell. What exactly they're investigating remains unclear. But Tillis wants it ended. Think about what's happening here. A Fed chair nomination, which should be about monetary policy expertise, is now hostage to a political dispute about the current chair. And the clock is ticking. According to CNBC, Powell's term expires in May 2026. That's weeks away. If Warsh isn't confirmed in time, we could have a leadership vacuum at the Fed. A leadership vacuum. At a moment when inflation is above target, energy prices are spiking, and the global economy is navigating a land war that disrupted oil supply chains. The next FOMC meeting is April 28th and 29th. Just days from now, the Fed is expected to hold rates steady again, but watch the statement language carefully. According to CNN, there's still a path to get Warsh confirmed, but it's tricky. It might require procedural maneuvers that could further politicize an already tense situation. So what does all of this mean for you? Let's get specific, because this isn't just Washington drama, it directly affects rate-sensitive decisions you might be making right now. First, if you're planning any major financing decisions, consider acting sooner rather than later. Leadership uncertainty tends to create rate volatility. Locking in now might make sense. I want to be careful here. Your situation is specific to you. Your timeline, your risk tolerance, your tax bracket all change the math. But the data suggests uncertainty is rising. According to CNBC's analysis, if Warsh takes over, consumers may face a more hawkish Fed, one that keeps rates higher for longer to prevent inflation from taking root again. Second, you might want to review your bond portfolio duration. If Warsh's hawkish stance translates to rate hikes in 2027, shorter-term bonds historically offer better protection. Here's the honest version. Nobody knows what rates will do in 6 months. Not the Fed, not Wall Street, not your favorite finance podcast. We can only look at historical patterns. And historically, a triple-hold pattern, which is where we are now, has preceded rate cuts within 6 months about 70% of the time. But that means 30% of the time, it didn't. Your job isn't to bet on the pattern, it's to prepare for both outcomes. That might mean staying diversified, keeping some powder dry, and not overextending on rate-sensitive positions. Third, consider keeping 3 to 6 months of emergency savings liquid. Given the elevated uncertainty from both geopolitical and policy factors, cash reserves matter more than usual. Now, I'm not saying panic. I'm never saying panic. Markets move, opportunities shift, but fear is rarely the right call. What I am saying is, pay attention. The numbers tell a story. Investors who sold during the 3 previous triple holds and sat in cash missed an average rebound of 14.2%. Investors who held through it, they were whole again within 9 months. The lesson isn't to never sell, it's to be deliberate about why you're selling. And that brings us back to Elena. Remember her? The 61-year-old staring at her Schwab app while her retirement account dropped $9,000 overnight. Her finger hovering over sell all. This is the moment that separates investors who build wealth from investors who destroy it. And the data on that split is brutal. The smart move, historically speaking, isn't to act on one data point. It's to know which data points deserve your attention and which ones are just noise designed to make you feel something. So here's what you might want to do. Watch the April 28 48ch FOMC meeting, not just the rate decision. That's probably another hold. Watch the statement language. Look for phrases like data-dependent or monitoring closely. Central bankers speak in code. Those words tell you more than the rate decision itself sometimes. And keep an eye on the Warsh confirmation drama. If Tillis lifts his hold, we could see movement fast. If he doesn't, the uncertainty extends, and volatility tends to follow uncertainty. Past performance doesn't guarantee future results. You know I have to say that. But more importantly, it's true. A pattern is not a prediction. Prepare, don't predict. If you found this breakdown useful, consider subscribing. We cover stories like this every week, the money stories that actually matter for your financial decisions. Look, the Fed chair drama might seem like inside baseball, political maneuvering in marble hallways. But every time the Fed makes a move, it ripples out to your mortgage, your car loan, your credit cards. CNBC reports that under a Warsh-led Fed, consumers could see sustained higher rates as the new normal. Not emergency high, but higher than the post-pandemic expectations most people still carry. That's a recalibration. And recalibrations hurt if you're not ready for them. They help if you are. The difference is preparation, not prediction. So talk to your advisor, run the scenarios, Ask what happens to your portfolio if rates stay here for 2 years. Ask what happens if they go up another quarter point. The answers to those questions, that's where the real value is. Not in predicting what Warsh will do or what Tillis will demand. In knowing what you'll do either way. This is what financial literacy actually looks like. Not memorizing ticker symbols, not timing the market, understanding how policy affects your life and positioning accordingly. That's the Fed chair fight. A nomination blocked, a policy shift pending, and a market waiting to see which way the wind blows. I'm your host. This is Money Moves Daily. Remember, this content is for educational and informational purposes only. It does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. Until next time, stay sharp, stay informed, and make moves that move you forward. We'll talk soon. Remember, this content is for informational purposes only and is not financial advice.